The last 2 weeks I've been a seller. I bought a lot
Really
of
cash.
I bought a lot of junior stocks, um, particularly uranium stocks, 6 or 7 months ago during a period of hatred. I probably increased my position in the uranium juniors by a quarter. This position was already large. And the stock that I bought because the sector was hated, I'm selling because the sector isn't hated anymore.
Hello, everyone, and welcome to another edition of Triangle Investor Interviews. I'm your host, Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy any shares, products, or services. Always do your due diligence and consult with your financial advisor. My guest today is one and only Rick Rule, resource investing legend and the man who can speak about almost every topic except tech, stocks, and crypto. Rick, welcome back, my friend.
Thank you for the disclaimer, Lucian. It's a pleasure to be back.
Thank you. Let's open our discussion about the market crash potential. You've said the biggest risk to all portfolio. Actually, I will quote you. You said the biggest risk to your portfolio is you. Given the current economic signals, high debt, inflation, volatility, how do you assess the likelihood of a market crash in this year, and what investors' behaviors do you see as the biggest risk amplifying such an event?
There's a lot of liquidity in the system, at least in terms of the US markets. And so I think the probability of a real market crash, a 2008 style crash, is low.
Mhm.
Low is not the same as non existent. And if there is a low probability event that has a high penalty, it's still statistically correct that you do the right thing to prepare yourself for it. That right thing is primarily not to treat the market as a subject, but rather a facility to buy and sell fractional ownership in businesses. If you pay attention to businesses that are selling at a discount to their intrinsic worth, a market crash becomes irrelevant to you. I remember the great market crash of 2008 as an example. In the immediate aftermath of the crash, everything fell.
Mm.
There were no bids, there was no liquidity, and the sell decisions weren't made by investors, they were made by margin clerks. First lesson, don't be on margin, at least not for speculative positions. But what happened is that very quickly the market began to sort itself out, which is to say that the higher quality asset classes and the higher quality companies rebounded, and they rebounded quickly. The lower quality stuff, the dross, took 9 months to recover and didn't really recover until the Fed flooded the market with liquidity. The lesson in terms of avoiding the crash is to develop the skill set and the discipline within your own mind to understand that the market isn't a subject, the market isn't a product, it's merely a facility. And you use that facility to buy high quality businesses. Buying high quality businesses at intelligent prices makes you ultimately crash proof. Most people won't do this, of course, because they don't want to do the work necessary and they aren't particularly disciplined. That notwithstanding, it's your job and my job to encourage people to behave rationally with regards to markets.
Very good point. Rick, how are you reading the current sentiment among the market participants you interact with, particularly your network of resource investors, mining executives, institutional players? Are you seeing excessive optimism, caution, or disconnect in their views?
I would suspect that we're seeing excessive optimism, uh, particularly in the high quality junior private placement financing markets. Despite the industry's claim that it's underfunded, the high quality private placements are invariably oversubscribed, and they're taking place. The terms that are being offered, let's just say they're much more favorable to the issuer than to the check writer.
Yeah, yeah.
Similarly, the high quality entrepreneurs, the really high quality entrepreneurs, are by nature optimistic people. A pessimist could never survive in an optimistic environment. And their lifeblood is capital. The fact that capital is freely available again has shifted all of the entrepreneurial managers into high gear. I just spent some time outside of Vancouver, British Columbia, at Bob Quartermain's birthday with a bunch of very, very, very high quality entrepreneurs. And I have to say, even the likes of Ross Beatty, who pretends to be retired, are putting the pedal to the metal. The availability of capital has really, really, really amped up the animal spirits of the best uh, of the junior company entrepreneurs.
Yeah, pretends to be retired. I know one guy who used to pretend he was retired, but he's not retired. I will not name him. Rick, let's talk commodities. I have 10 commodities on my list. I want to hear pros and cons and current assessment of those. Let's start, of course, with gold. How do you see gold now, tomorrow, and what are the key risks that could undermine its long term value proposition?
In the very near term, the anti-dollar trade is really overcrowded. Everybody around the world is looking to express their discomfort with the disconnect between U.S. inflation and U.S. interest rates, and the probability that U.S. interest rates get lower. The anti-dollar trade is the pro-gold trade, and that's in the near term, I think, extremely crowded. So it wouldn't surprise me that in the near term, the money's been spent, which is to say that the positions have been established. Two, there's confidence in the market. There is so much liquidity in the market that the chance of a near-term liquidity squeeze, I think, is extremely low. Third, the VIX, the volatility index, is asleep. I mean, the VIX chart looks like the electrocardiogram of a dead person,
Yes,
which
yes.
suggests that there isn't very much fear in the market, and it's fear that drives gold. Um, for me, that's tailor-made. Um, Despite the fact that I own a lot of gold, I'd like to own a lot more. I think in, as you know, 5 or 10 year terms, and the fact that gold is likely sideways to down is of no particular concern to me because I think it's sideways to down for the 3 to 6 month time frame. The thing that would change that assessment would be a major cut or a series of minor cuts by the Fed to the U.S. interest rate. If Trump and Congress is successful in pressuring the Fed to cut the interest rate after the inflation report that was just tabled, that will tell savers and investors around the world that U.S. society has decided to abandon the integrity of the U.S. dollar. Uh, if that happens, I remember when that happened in 1975, and that set off a real romp in the gold price. I hope that there is not political consensus in the United States for an interest rate cut. I know from my dealings with lower level people at the Fed that the institutional bias of the Fed is not to cut the interest rate, in fact, to defend the integrity of the dollar. Uh, but those young people at the lower level in the Fed, let's just say that their preference relative to President Trump's preference enjoys fairly limited circulation. So, absent a cut in the U.S. interest rate, I think the anti-dollar trade, the pro-gold trade, is very crowded. It's no longer what it was when we started talking in 2022. Uh, all bets are off if they make a meaningful cut or a series of small cuts uh, in the interest rate.
Agreed on this. Silver, Rick. Silver straddles the line between a precious and industrial metal, given its dual demand drivers. What do you see as the primary catalyst for silver price in the next long-term horizon, 3 to 5 years, and what vulnerabilities might investors overlook?
People point to its utilization as an industrial metal to suggest, depending on their point of view, that the future silver is bright. For 50 years, I've never seen silver's price action suggest that in a financial sense, it's an industrial material. Uh, Silver moves when the generalist investor comes down into the precious metal space. When the momentum in the precious metal space has been established, and when the precious metals narrative has been established by the move first in gold and then by the senior gold stocks, when the generalist investor comes into the precious metals space, perhaps because of silver's lower unit cost, leadership changes from gold to silver. And Lucian, believe me, when that happens, you won't need me to tell you what happened. The move from $36 to $38 or $37 to $39, $35 to $37, that becomes irrelevant. When silver runs, it really, 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 truly runs. I am of the belief that we are in the relatively early stages of a fairly profound precious metals bull market, a bull market that I would suggest rivals the bull market of the 1970s. It's important to note that there can be incredible volatility in markets like that. There can be years like 1975 where the gold price falls by half without disrupting the primary trend in the gold bull market. If I'm right about the magnitude and the duration of this market, at some point in time, you will see leadership change profoundly from gold to silver. And when that happens in American parlance, grab the saddle horn. You are in a real true rodeo. As I say, you won't need me to tell you it's occurring.
Got it. Copper. Everybody's bullish on copper in the
Yeah,
long run.
that's
It
another
is.
that's another crowded trade. Uh, if
Yeah, Rick, but do you believe with this bullish narrative, or are there any supply chain or substitution risk that could derail this trajectory for copper?
No, but I think the trade is overlong right now. I think the oil price tells us that we aren't approaching an economic slowdown, that we're in an economic slowdown. And copper's extremely, extremely price sensitive. In the 3 year, 4 year, 5 year time frame, the copper price takes care of itself. That die was cast 25 years ago. We haven't, for the last 2.5 or 3 decades, made substantial investments in the copper business. The consequence is that society is living off deposits that were discovered 35 years ago, built 25 years ago, and are like me, long of tooth, past their prime. And there's no way to correct this in 5 years. We can't do it. Uh, so 3 years, 4 years, 5 years from now, we face a circumstance with fairly profound levels of production decline. And even if demand holds steady, there won't be sufficient supply to match demand. In the nearer term, however, and whether they should or not, most of your listeners think in the near term, copper is a economically sensitive material. And investors' perceptions are very, very short term. You may remember the so-called silver squeeze in the
Yes.
early part of the last decade. Investors bought the narrative. They bought it hook, line, and sink. When their expectation didn't take place within their time frame, which was a nanosecond, they went from loving silver to hating silver. It wouldn't surprise me in the very near term if there was softness in the copper quote as a consequence of deteriorating economic conditions. And if the love that copper currently enjoys turns into, in the near term, hate. And I'm okay with that. I personally don't have any trauma holding stock over a long weekend.
Same here. My favorite and one of your favorites is uranium. What are the structural advantages of investing in uranium now, and what geopolitical or regulatory hurdles could cap its upside?
Let's answer those in reverse order. The regulatory hurdles are becoming less. It has been interesting to watch over the last 5 years the public perception of uranium going from being a pariah
Yeah.
being, in this country at least, subsidized. That's insane. As a uranium speculator 5 years ago, I was vilified, and people were suggesting on Twitter that I'd be jailed. And now Congress wants to subsidize me. I need to say I felt cleaner when I was vilified. And this isn't just an American phenomenon. In Japan, the population over 10 years went from being 85% opposed to restarting the Japanese nuclear fleet to 70% in favor. That's an it's a seismic shift. And we're seeing that around the world. So the regulatory burdens are getting less and less. Understand, Lucian, in the back of your mind, if there's another incident like 3 Mile Island or Fukushima, that can turn on a dime.
Yeah.
It's a low probability event with a high penalty for failure. So, in terms of establishing a uranium portfolio, don't use money that you couldn't afford to lose half of in the event, in the occurrence of event that probably has a 2% or 3% chance of occurring. It's important to know that. Now let's go back to the structure. What's important to know about uranium is, first of all, there is a supply deficit in terms of current production relative to current consumption. Understand, too, that consumption is growing rapidly, so the supply deficit gets worse. There are still above ground inventories, in particular, inventories controlled by Japanese producers who aren't selling the material because they know they're going to need it in 3 or 4 or 5 years. They're leasing it. So the uranium gets transferred from Japanese users to Chinese users. The Japanese aren't selling it for money. What they're doing it is leasing it at a 5 or 6% interest rate, repayable in uranium. So we're forward loading supply in effect. And this will come back and impact the market. There is zero doubt about that. The second thing to understand about the uranium market is that the structure has changed completely. Uh, Most investors think of the uranium market in the context of the spot market, which is becoming less and less relevant and less liquid. The action is taking place on the term market, and this is wholly a good thing. Among other things, a builder of a nuclear power plant who goes to the bank to borrow $5 billion of the $7 billion it might take to construct the plant can lock in the price and the volume of uranium that they need to amortize the loan, let's say 20 years worth of uranium. They can do that up front. You can't do that in any other commodity. If you and I were building a peaking plant for natural gas, somewhere it's needed, like Germany, the probability that you and I could lock in secured supplies of gas for 20 years at a fixed price is nil. But in the uranium business, we can do that right now, and we can do it with credit grade counterparties. And that means that we can take those contracts literally to the bank if the counterparty is credit grade. Uh, People aren't understanding this at all. At the same time that those long-term fixed price contracts work for the utilities, enables them to secure the financing for the nuclear power plant. It works for the producer too, because the same banks that finance the power plants could finance the construction of uranium mines, and they will have a better sense of certainty with regards to price, volume, and hence revenue and margin in uranium than they will any other natural resource commodity.
Yeah,
Um,
let's stay on uranium for just a second. Utilities are pretty dormant. Do you believe that they will wake up this year and start securing more uranium, in your opinion?
they're waking up. The truth is that you aren't seeing the term markets take place because there's no current requirement that companies disclose the terms of the
Yes.
contracts. Uh, we are also seeing uh, some utilities and some producers sign contracts with trading companies. I believe that to be a mistake. The trading companies generally aren't investment quality credits, which means that the those contracts obviate the advantage that either the utility or the company might have in terms of cost of capital. But the traders traditionally have supplied um, liquidity in the market. And as a consequence of, I would suggest, prior habits, some of these supply contracts, which should really be between producer and consumer, are being financed through an intermediary, a trading company. Now, this is a wonderful business for the trading company, a wonderful business for the trading company. If you can enter into a supply contract, let's say with Tokyo Electric Power at $80 a pound indexed for 20 years, and you can secure that supply with Kazakhstan at $72 a pound indexed for 20 years, you're making $8 a pound. And what you really have to do is put up the capital for the margin. That's all you have to do. I'm not sure how that benefits either Kazakhstan or Tokyo Electric Power or China General Nuclear. But the truth is that the intermediaries have done a very, very, very good job in the contract market.
That's a very good point, actually. Let's move to oil. How do you assess the long-term investment case for oil, and what are the biggest risks to its demand outlook?
I don't see a risk to demand. Um, the big thinkers are suggesting that peak oil demand occurs something like 2030, 2032. That's an insanity. I mean, how would they fuel 1,000 private jets to fly to Davos to tell us to drive less if there was no oil? uh, so I think peak oil demand, well, really it's a function of price, but I suggest peak oil demand occurs 2060, 2065. When securities analysts, and for that matter, credit analysts, are valuing oil company equity and oil company debt, uh, and they do discounted cash flows, what they're doing is they're assuming peak oil demand in 2032. And the long tail on the net present value curve, they're leaving off the valuations. If you believe, like I believe, that peak oil demand occurs in 2065, and you do a net present value calculation of, let's say, Exxon, if you're using, let's say, an 8% discount rate for Exxon, basically any free cash flow that they enjoy after year 9 doesn't show up in the net present value calculation. But the truth is, if the oil market is as firm as I think it is, after 9 years, you restart the net present value calculation all the way back at 100. There's this big fat tail. And securities analysts aren't assigning oil companies any tail whatsoever, which I think is profoundly stupid. I would suggest to you that the better international oil producers, which include Exxon, are selling at half my estimate of their value. Uh, the best Canadian producers are burdened by a further discount to that because of federal politics in Canada. Now, this is not a trade for the faint of heart. It is also not a trade for somebody with a short-term time frame. But this period reminds me of nothing so much as the early part of the decade of the 90s, when oil was in extraordinary disfavor as a consequence of its poor performance through the latter half of the decade of the 80s. I remember buying sub-investment grade bonds, Canadian oil producers, well covered by reserves. The bonds had a face yield of 12%, and they were selling at 60, meaning that my running yield was 18%, and my yield to maturity was more like 25 or 30%. That the degree of disfavor that I'm seeing in the market resembles that period.
Nice. Rick, one commodity that I think you are not talking so much often is potash. Global food security concerns grow. Potash is critical for agricultural yields. What are the key tailwinds for potash demand, and how do you view the risks of oversupply or geopolitical disruptions in major producing regions?
Uh, the industry, that is the producing industry, is enjoying disruption now. The lowest cost, uh, highest volume potash producer in the world is Russia,
Yeah.
and there are some constraints to Russian production. The swing producer is Belarus, and global capital markets have not been kind to Belarus. And the country and the country's ruler have been, let's just say that they have been more interested in using the free cash flow from the potash industry for other purposes than making sustaining capital investments, as has Mr. Putin. He's obviously had a use for cash. Uh, the bedrock producer then, not the most efficient producer in the world, but the bedrock producer is Canada, and they've been benefiting immensely. In the very near term, the Jensen deposit will come into production from BHP. This will be a major source of supply, and I suspect that it will be in the bottom cash cost quartile worldwide. If you saw peace in Ukraine and you saw a reintegration of Russia into the global financial community, you would see softness in potash. The Russians will not, for 3 or 4 years, be able to reclaim their low-cost status because they haven't been making sustaining capital investments since the beginning of the war with Ukraine. And the lack of sustaining capital investments will make the Russians in the near term less efficient producers than the Canadians, who have in fact been making sustaining capital investments. But over time, the quality of the Russian deposits is superb.
Yeah.
Uh, I uh, I did very, very well for 20, 25 years with Russian mining oil and gas stocks until I didn't. They got even with me. Very, very, very well. They didn't get even. I made so much money in the 2 decades before that it didn't matter. Uh, but if there is peace uh, in Western Russia, and if Russia begins to integrate or reintegrate into the world economy, the most undervalued equities in the resource business on the planet are Russian. And I'll be back on Russia like white on rice.
So you are eager to see what happens after the meeting between Trump and Putin.
I think that's probably theater.
Mhm.
I don't know, but I assume that that's theater. But I mean, for a whole bunch of reasons, the least of which, frankly, is my portfolio. It would be lovely to see geopolitical tensions between the United States and Russia dissipate. It would be lovely to see an end to that conflict.
Agreed. Agreed. Rick, let's move to lithium. What do you see as the sustainable growth drivers for lithium, and what are the risks of technological shifts of recycling reducing its necessity?
We have to digest all the money that was invested in lithium, over the last 10 years. Uh, Demand for lithium grew very quickly, and as a consequence of that, demand outstripped the processing capacity for lithium. Investors mistook that for a shortage of lithium itself. That was never a problem. At peak demand, SQM suggested that they had 80 years of proved producing reserves. In the 5 years that the boom took place, the industry, particularly the Chinese industry, invested massively in lithium processing. The consequence of that is that given that the raw rock lithium was available, the lithium price collapsed. We probably have a year and a half or 2 years to digest the supply imbalance. Um, Lithium exploration was extremely efficient because we hadn't looked for it for a very long time.
Yeah.
And when we threw billions of dollars at looking for something that wasn't scarce, we found a lot. And there's probably 100 or 120 deposits that would have been economic at the lithium prices that existed 3 years ago. Maybe three or four, maybe five of those deposits actually come into production. So the market has to sort through a circumstance where the universe of aspirants is 125 and the universe of successes is 5, which means that there's a lot of disappointment coming up in the lithium business. Another risk and I don't know how to assess it, I'm not smart enough, is the fact that a whole bunch of folks, including Berkshire Hathaway with Mid-American Power, Exxon, Chevron, Occidental, are experimenting with direct lithium extraction. The idea that you could take, as an example, lithium-rich saltwater brines co-produced with oil and gas, or with, in the case of Berkshire Hathaway, geothermal brines in the Imperial Valley of California. If this works, um, that'll be very, very, very tough on the hard rock lithium producers. Because understand, if you're in the oil and gas business, or if you're in the geothermal business, lithium is a cost. It is a material that precipitates out of the brines and fouls your gear. I'm not saying that this technology is going to work. I don't know. Uh, but I know that the successful outcome is appealing enough that some pretty smart folks, like the folks at Exxon, are spending tens of millions of dollars and are confident enough in the technology that rather than relying on existing saltwater brines, they're actually leasing land uh, that has salt waters that are particularly rich in lithium brines. That signals some confidence to me. So I'm very cautious around all but the biggest and the best and the strongest lithium producers.
Okay, three more. Let's move to PGMs, platinum group metals. PGMs face a complex outlook with declining internal combustion engine demand, but rising industrial and hydrogen applications. Where do you see balance of opportunity versus risk in PGMs
Well,
for,
I
let's
remember
say, the next decade?
a year ago, you and I talked about PGMs, and I said what I liked about them is they were hated, but there
Yes.
were very few ways to play them, and that exists until today. The most efficient PGM producers in the world are in Russia, Norilsk. Uh, I would suggest that the decline that you saw in platinum prices, PGM prices, beginning 4 years ago, was all about Russian disorting. The Russians needed money, and they sold whatever they had, which was mostly nickel and platinum. I think the Russians ran out of supply 7 or 8 months ago, and the reason that the prices have rebounded, I think, is because the Russian shelves were empty. Now, Lucian, as you know, Mr. Putin does not call me on a quarterly basis to report his stocks. This is all my surmising these things. The second big source of supply is South Africa, where there are structural issues. You have a government that would like to address prior wrongs. And the consequence of that is that they're always flirting with the nationalization of the mining industry. What that means is that the mining industry is loath to make the capital expenditures that they need to make because they don't know who's going to own the mines. And that means that they substitute labor for capital, and that means that the miners are paid less than it is required for them to live. That's a difficult place to be an investor. If you can't make capital investments that would allow your workers to be paid a living wage to employ enough capital, and if you need to increase the pay of the workers, but the workers don't generate enough utility to support that pay increase, that's an ugly place. Uh, a rational investor absent that would be all over Sibanye Stillwater, as an example. But you can't be absent reality. So I've looked for ways to express my preference, for platinum, and the consequence of that is that I've had to crowd myself into some advanced exploration plays, as opposed to what I would normally do, which is to start my portfolio with the biggest and the best. I don't believe that uh, fears of the demise of the internal combustion engine are that real either. I believe, particularly in emerging and frontier markets, that demand for internal combustion engines will continue at least on pace with where they are now. I'm personally a huge bull on places like Indonesia and Pakistan and Malawi. And there's a progression taking place in those countries that took place in China in the decade 2000 to 2010. That progression is barefoot to tennis shoes to bicycles to 50cc motorcycles to Toyota Hilux pickup trucks. And I think that this progression takes place for 30 years. And I think that air quality standards are popular globally, politically. And I see demand for PGM metals in catalytic converters continuing strong. But I also see a circumstance where the 5 year, 4 year period of weakness that we had in platinum and palladium prices increased basic research into the catalytic properties of platinum and palladium, and that research will yield new fabrication applications for platinum and palladium that will last 25 or 30 years.
Very good point. Rick, what's your take on zinc?
Don't have one. Economically sensitive. Zinc has made me a lot of money from time to time, but it's required a lot of patience. It would seem that we don't look for zinc or build production capacities when the zinc price is soft, which is most of the time. And then when zinc comes back into favor, the price skyrockets, the shares skyrocket, and in zinc-rich places, uh, central Mexico, Peru, northern China, uh, zinc production skyrockets and crashes. It's also very tough to find pure or semi-pure zinc plays. You need to express your preference for zinc elliptically in companies like Tech Corp or Glencore. It's difficult to find a pure play zinc producer that is in the best cost quartile worldwide while similarly being in the highest return on capital employed worldwide. That perfect zinc company has eluded me for 30 years.
Okay. Final one, Rick. Graphene and graphite. Graphene holds transformative potential, but scaling production remains a challenge. How do you view it?
There's a fascinating promotion taking place on the Toronto Stock Exchange right now. I forget the name of the company. A former colleague of mine from Sprott, Kevin Bambro, a very
Yes.
bright guy, is conducting what is probably uh, the most flamboyant online promotion I've ever seen. He's a very bright guy, by the way. I don't know enough about graphene to have a comment. Over the last 20 years, graphene's primary utility has been to sell investment newsletters uh, because the story, the upside, is so spectacular. For 20 years, that story hasn't been true, which is to say, the only application for graphene has been to sell investment newsletters. Uh, One is cautioned uh, not to short progress. In other words, the fact that we haven't developed applications in the last 40 or 50 years that I've been in the business doesn't mean that those applications won't be developed. I'm just not smart enough to spot them. I'm much more familiar with the graphite market, which is a very, very tough market. I mean a tough market to understand. We think of it as pencil lead, but there's a whole bunch of grades and a whole bunch of applications around graphite. So it turns out to be a very diffuse and very complex market. I'm way long uh, an issuer, an Australian issuer called Sovereign, which controls what is believed to be the first or second largest high quality graphite deposit in the world, and also contains the first or second largest rutile deposit in the world. I'm attracted to this because the in situ value, recoverable value of reserves and resources there probably exceeds $20 billion. We think, don't know, think that it'll be in the lowest cost quartile worldwide for both rutile and graphite, and the best quartile worldwide in terms of return on capital employed. Because we don't know, because there's uncertainty, and because there's investor skepticism around Malawi, that stock, uh, despite the risks, seems to me to be very cheap uh, for speculators. for people who can take political risk and market risk 3 or 4 or 5 years out. I happen to be one of those people. So I express my preference. I love great big deposits in out of favor commodities, in out of favor countries. I'm not one who bemoans particularly a 50% loss if the premise was correct, because having a willingness to accept those 50% losses has occasionally resulted in a 20-fold or 30-fold gain to me. Um, People get attracted to the concept of a 20 or 30-fold gain, but they need to ask themselves if they're willing to stomach a 50% risk,
Exactly.
while also understanding that it might take 5 or 6 years to get that 20-fold gain. And during those 5 or 6 years, they could easily be exposed to a 50% decline in the share price that wasn't a loss, that was transitory and temporary. So people who are listening to this who say, "Oh my God, I'd really like I'd really like a 30 bagger," understand the psychological and financial risk associated with obtaining a 30 bagger.
That's the school you learned with John Borshop when you bought Paladin at 10 cents. It went to 1 cent, and then after that, it's all history.
Yeah, a 90% decline is a real character builder. And
Yeah,
Lucian, it was completely unnecessary. I was already a character.
yeah,
I didn't need
definitely. Definitely. That was 10, Rick. We covered 10 commodities, but my final question, what specific investments are you making or planning for the remainder of 2025? And which sectors do you see offering the best high reward, low risk opportunities?
The last 2 weeks I've been a seller. I bought a
Building
lot of
cash?
I bought a lot of junior stocks, um, particularly uranium stocks, 6 or 7 months ago during a period of hatred. I probably increased my position in the uranium juniors by a quarter, and this position was already large. And the stock that I bought because the sector was hated, I'm selling because the sector isn't hated anymore.
Hmm.
Similarly, I started going down market in the gold juniors uh, probably a year and a half ago. I mean, I started with big positions in the juniors, but I added to them because it was very clear to me that the increase in gold price would increase the free cash flows of the majors. And so leadership in the bull market would shift to the majors and eventually come down to the juniors. That's occurring now. So the juniors that I bought because they were oversold, I'm selling. Uh, I'm not selling my Franco. I'm not selling my Agnico. I'm not selling my Wheaton. I'm not selling my high quality names. But some of the Me Too names that I bought, some of the 30 centers that I bought because I thought they'd see a buck, have seen a buck. When you accomplish your goals, it's important that you act on it. Too many people have their narrative justified by increasing share prices, and they don't take into account that once they've already earned a triple, the next triple is much harder. So if your reason to buy a stock is because it's hated, and that's a really good reason from my viewpoint, when the sector ceases to be hated, your reason to own that slice of stock is probably past.
Yeah.
So I've been a seller. I have been a buyer of the last sector that's out of favor, which is to say the prospect generators and the high quality explorers. People are looking, they're trying to find the next Artemis, they're trying to find the next developer that will triple during the period between commencement of construction and commencement of production. Lobo Tigre's famous golden runway. That space is getting crowded now. And so what I'm looking to do is find the out of favor explorers that likely will move a year and a half or 2 years from now.
Fair enough. Rick, are you still ranking the portfolios for other people?
I am. I am. Any of your listeners who haven't been offended by what I've said about their favorite subjects can personalize what I do in resources. You can go to my website, ruleinvestmentmedia.com, and list your natural resource stocks. Lucian, as you were kind enough to say, no tech stocks, no pot stocks, no crypto,
No crypto.
pure
Yeah, yeah.
stocks only. Note too that I'm still about 250 rankings behind, so give me 7 to 10 days to respond. But if you submit your stocks, I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value, and this is free, no obligation.
I have an idea for ranking. You should rank commodity hating. I believe that would be a bestseller. So if you can rank commodity as hate from 1 to 10, that would be perfect.
The
Rick, thank
main,
you very much for this interview.
the maintenance of the ranking database is already arduous. I can't, I can't at age 72 add more factors. I just don't have the mind span.